I'm Jason Stipp from Morningstar, and welcome to the 200th episode of the Friday Five. 5 big takeaways from the last 4 years. Joining me, as always, with the Friday Five is Morningstar Markets Editor Jeremy Glaser. Jeremy, thanks for being here.
You're welcome, Jason.
So it's been almost 4 years since we started the Friday Five. We've seen a lot of big changes. You have 5 of the biggest here today.
Yeah, the themes we're going to talk about today are the recovery, Washington, Europe, corporate America, and finally, the pace of change.
Sitting here 4 years ago, there was a lot of questions about the recovery, the double dip, all the issues that were still out there. But now we can say with certainty that this recovery is real.
Yeah, there were quite a few worries. If you remember, in 2009, we were talking a lot about green shoots. Any little positive piece of economic data was scrutinized as maybe a sign that the economy was finally pulling out of the tailspin that it had been in since the onset of the financial crisis. And I think over the last 4 years, that's been one of the big recurring themes, that the recovery is in fact real, that it has legs, that it wasn't, kind of a house of cards that was just ready to collapse, even if the pace was, kind of excruciatingly slow at times. And we've seen that across, a bunch of different sectors and a bunch of different metrics. Look at things like consumer spending. You look at, manufacturing and autos and how that's really come back, how housing is starting, to come back in a big way in many parts of the country. But that being said, that is at a very, kind of slow level. And you see that, I think, in employment the most clearly. Employment growth, in 2009, we were still losing, potentially hundreds of thousands of jobs every month. And that's obviously turned around. But we're not adding jobs at a very, robust pace. Things are getting better, but we're still far from, the employment levels that we were, pre-recession levels. We're having a lot of people drop out of the workforce, some of that because of demographics, but some of that just because it's difficult to find work, lots of long-term unemployed, which is something that we haven't seen in quite some time. So even though the recovery is real and we've seen it and it's been manifest through a bunch of different, avenues, it's still not, a really robust recovery that people can get, incredibly excited about. And I think that it's still going to be a story for a while, waiting till we get back to true normalization.
Over the last 4 years, Washington, D.C., the government has had a big hand in both the markets and the recovery, both through monetary, fiscal policy regulations and reforms. You say on balance that's been a mixed bag.
It really has. When you look at fiscal policy, you started off with a lot of expansionary policy with the stimulus after President Obama took office, and then that really started to reverse course, and we saw the federal government starting to make some cuts. We lost jobs in federal government, in state and local. Has been one of the drivers of kind of that slow employment growth, and I think that's had obviously an impact on economic growth. But at the same time, you've also had some self-inflicted wounds come from Congress and from the president. Things like the debt ceiling debate that led to the S&P credit downgrade of the United States sovereign bonds. You have some of the fiscal cliff issues that took so long to potentially resolve and created so much uncertainty there at the end of 2012. And these are kind of concerns that certainly did not help the recovery very much. I think the fact that the economy has still grown kind of through all of this is a sign that it's not it is relatively robust, that it's not just going to be knocked over easily. But I think when it comes to Congress, when it comes to the executive branch, there could have been kind of more support there in keeping things going. While on the other hand, the Fed has been much more accommodative and much more flexible when it comes to making sure that their easy money policy really stays in place. So it's everything from new quantitative easing programs, things to more robust communication to try to convince the market that rates are going to be very low for a long time. And obviously the Fed is going to have to exit from this eventually. We got a little test run of this exit just a few months ago that was a little bit rocky. But I think the fact that the Fed tried to walk that back almost as quickly as they rolled it out is a sign that they're paying attention to what the market's doing. They're paying attention to the potential consequence of their action, and they're not going to pull back before they really think the economy is ready. And I think that's potentially a good sign.
Across the pond, Europe has taken us on a real roller coaster ride over the last few years, and you say that ride is still going on, but maybe the biggest thrills, the worst of the thrills, are past us at this point.
Yeah, Europe is still a bit of a mess, but it's more of a functional mess than it was just a couple years ago. The Eurozone has not dealt with a lot of the structural problems that have caused, some of these flare-ups in interest rates and flare-ups and worries about, the Eurozone collapsing over the last couple of years. You still have fiscal policy, being determined by individual governments, but monetary policy, being determined out of Frankfurt. And that's something that really is, potentially a challenge. That structure is a challenge until they kind of find a way, to build new institutions and to figure a way to fix some of those structural competitive problems, it's always going to be an issue. However, the ECB, went from being somewhat unhelpful to being, quite helpful, with Mario Draghi, the head of the ECB, saying that he'll do whatever necessary to keep the euro together. That's kept yields low. That's allowed the preferred countries, some breathing room to try to make some of these changes. But we keep seeing flare-ups here and there, things like Cyprus, things like Portugal, and there'll probably be more of those in the future. It's going to be a multi-year process until they've figured a way to really work it out. I think they've created a roadmap and they've created the room to do it, but there's still potential problems in the execution and problems that could pop up.
Back here at home, we have that sluggish economy, as you mentioned, but one bright spot has been corporate America, which is maybe as strong as it's ever been.
It has been, and I think it's been a bright spot in a few ways. I think corporate earnings certainly, have come back in a big way, when from the recession. That corporations were able to cut costs, very effectively. Now, part of that is why unemployment is so high. They were able to shed so many workers, but that did translate into better corporate profits. They were able to get rid of unprofitable arms, really rationalize their businesses. Most managers did a pretty good job of, kind of recovering from, in some cases, near-death experiences. In 2008, 2009, to really being much more robust and much more safe companies today. We've also seen a bright side in terms of stewardship, that we've seen a lot of a lot of capital being returned to shareholders, either through dividends or share buybacks. Instead of going out on acquisition sprees, which is something that we were worried about with all this cash building up and with the low interest rate environment, they've been returning that cash to shareholders. And part of that is because shareholders have been demanding it, because there just isn't that much yield elsewhere. But it seems like corporate boards are being a little bit more active, or being a little bit more hands-on in making sure that the stewardship is there, and that they're not taking on risks that they shouldn't be. And I think that's a good sign from corporate America.
And lastly, Jeremy, although we've seen a lot of changes over the last 4 years, you say one thing that's maybe even more surprising than the change themselves is the pace of those changes.
It has been. I think sometimes we think that change happens relatively slowly, but I think there's a few cases over the last few years where whole industries have shifted very quickly. Look at the tech. That the tech industry is an area where, of course, you expect change, but the rise of tablet computing, I think, caught many people, including myself, off guard. We even said when the iPad launched that, it just looks like a giant iPhone. You'll just stitch 9 together and you're basically there. Then that obviously turns out that lots of people wanted a big iPhone, and the drive of tablets really helped Apple continue to grow and become the behemoth in terms of market share that it is. And it also had knock-on effects that there's many fewer PC sales. PC sales have been under some pretty extreme pressure over the last couple quarters and over these last few years, and a lot of that is because of smartphones and tablets and more devices. You look at the natural gas industry, where it looks like potentially the next couple of years the United States will become a net energy exporter, which is something that would have been unthinkable for many just a few years ago. The rise of fracking has created really low natural gas prices and has created a big flow of energy. This has big effects on manufacturing. They can get cheap energy, and a lot of other industries, potentially. And I think that's a story that is just beginning to be told, but it's having huge impacts on a lot of different places. Or you look abroad in emerging markets. China goes from the growth darling to something that we're worried about their growth. And even if it's still going to be positive, is it growing fast enough to kind of support a lot of the economies around it, to support commodity markets? What's going to happen with Chinese real estate, with the Chinese banking sector? A lot of those were questions that weren't on top of mind just a few years ago. I think the big takeaway from that pace of change is that it's very difficult to time the market. That even if you have the insight right, exactly when some of these changes could happen is difficult to pin down. When it comes to consumer adoption, or it comes to when or what any particular commodity price is going to look like at any given day. I think it just speaks to the importance of being more of a buy and hold investor, to having a good asset allocation, to keeping on track of your investments, making sure that it's not buy, hold, and forget, making sure that some of these trends aren't kind of derailing the thesis of why you bought various securities, but kind of being there for the long term, I think can help kind of weather these big changes as they come.
Jeremy, 200 informational episodes, 4 insightful years. Thanks for joining us every week on the Friday Five.
You're welcome, Jason.
From Morningstar, I'm Jason Stipp. Thanks for watching.